But this weekend, cash-strapped trucking company Yellow shut down operations and is filing for bankruptcy. 30,000 jobs could be affected. What impact will it have on the supply chain more broadly and on shipping prices? Tom Nightingale is CEO of AFS Logistics. It's a privately held firm that manages $11 billion of freight spend annually. And Tom, it's good to have you here with us to break this down today. Welcome.
Thank you. Pleasure to be here.
What's the immediate effect, you think, of Yellow shutting down?
Well, thankfully, the industry's had some time to prepare for it because it's been coming for a while. So a lot of that freight has been absorbed into other systems. And the less than truckload sector, which is where Yellow participates, has been one of the smaller sectors historically. So the overall supply chain will be fine. However, there obviously will be near-term impacts, particularly in the pricing and matching supply and demand in the less than truckload sector.
Right, although I'm not sure we should jump to the conclusion that we'll suddenly be short on trucking supply. My understanding was during the pandemic, when demand and prices absolutely soared, you had a ton of new entrants. Yellow was financially vulnerable from the debt load over the years, a bunch of different kind of expansions it tried to go on. It was ailing even before the taxpayer loan to get through COVID. The taxpayers still own 30% of this company now, which I presume is worthless. So are we still in the situation of having a glut in freight capacity?
Yeah, and that's a relatively recent turn. Obviously, during the pandemic, people were cooped up at home and purchasing quite a bit. So the supply and demand situation was very different during the pandemic, but certainly when it turned more recently, Yellow and that debt load that you mentioned really came to bear the burden of that, unfortunately.
So you lose a competitor in the space, not necessarily an unexpected loss, but that means there's one less competitor. That would suggest that prices might go up a little bit among those remaining competitors. Who's going to be most affected if there are price increases? And then do those price increases get passed along, say, to the consumer who is buying goods from, let's say, Dollar General or whomever is using these companies?
Yeah, it's a great question, Tyler. The reality is that the competitors out there are relatively concentrated. So across the entire less than truckload sector, you're really only looking at about 80 competitors and really only about 20 of any significance. Certain competitors will benefit more because their freight networks tend to align and their value proposition tends to align a little bit better. Those competitors would be XPO, Transforce or T-Force, and ABF Freight should benefit the most from this situation. There are, however, others that on a regional basis will benefit because Yellow had a fairly substantial regional business. And those are not necessarily the household names and certainly not the publicly traded names that we would come to know from watching your shows.
Can I pivot you now to UPS? And there, I think, if I'm reading my notes correctly, you think there will be price increases because there's no other way that UPS can really pass along the extra cost or cut costs sufficiently to blunt the impact of the labor deal they made last week.
Yeah, that's correct. The UPS network has been very efficiently run for a very long time. And what we saw in the tentative labor agreement that was reached last week is a fairly astronomical wage increase. And a wage increase of that magnitude, when wages and benefits occupy as much of UPS's cost to serve as they do, have to be passed along or compensated for. And passing them along really equates to a broad-based increase in prices, both for shippers and for us as consumers.